Welcome to Crossborder Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform to the OECD's latest developments. I'm Doug McHoney, PwC's U.S. International Tax Services Leader. You can follow me on Twitter at XBorderTax. On this week's episode of Crossborder Tax Talks, I'm excited to have back Matt Chen. Matt is an international tax partner in PwC's Washington National Tax Services practice. Matt has a unique perspective as a former international tax director at a Bay Area technology company before he rejoined PwC here in Washington, D.C. Matt joined us for a previous episode of Cross-Border Tax Talks, but this will be his first appearance on our video recording, which can be found on my YouTube channel. Matt, welcome back to the podcast.
Thank you, Doug, and good to be back.
And your first official appearance on YouTube, I believe, as well.
That's right. Hopefully it's good lighting.
We've worked a lot. We've worked very hard on that. You look fantastic, Matt.
Thank you, you too.
Thank you. All right. So this week we're going to be talking about the cloud computing regulations. So these have gotten a lot of press in the tax press amongst our fellow international tax nerds. Mm-hmm. And I'm very excited to learn more about these particular regulations. I thought before we really even dive into what's in the new regs, just giving a little bit of context on the history of these prior regs, because what we always refer to sort of the tax wonks as the -18 rules were really drafted 23 years ago. I think was it 1996?
96 when they were proposed and finalized in 98, yes.
So I mean, a lot has happened in 21 years. In fact, I think I got my first cell phone about then. And how the world has changed. And those regs were very focused on copyrighted articles. And back when we had things which I think a big group of our audience has probably never even seen or heard of, called floppy disks.
That's right.
And you actually would buy a floppy disk at a merchandiser and then stick that thing into your computer to be able to get some software loaded on. But give us a little bit of the context of the prior regs, then we can talk about what's in the most recent reg package and the Treasury's attempt to at least modernize some of these rules.
Sure, Doug. And as you pointed out, back in those days, we actually used softwares they are transferred through physical medium for the most part. So you bought floppies, and CDs might have been considered cutting edge at the time, and the really, really cutting edge was downloaded software in the late 90s. And so back then, the IRS and Treasury decided to write regulations that govern the tax characterization of computer programs. And what they mean by characterization is, well, you look at a computer program transaction, whether it's downloaded or you purchase off the shelf, and you analyze the terms and conditions of that software transaction and decide whether it produced sales income, rental income, or maybe in some cases, you're dealing with copyrighted IP, software IP that could produce royalty income. But the presumption back then was people used software in a way that requires downloading or installation onto someone's computing device.
Right.
And of course, now a lot of the well, first of all, two things. Number one, consumers don't just get downloaded software anymore. It's also downloaded books, movies, and music.
Right.
And in many cases, there's no download whatsoever. So things are accessed through on-demand network. So you can have movies that are either downloaded or streamed.
Right.
Same thing with the use of computer software. It may not even be installed on your computer at all. And so what do you do to keep up with evolving technologies? So this is really the first set of regulations that directly address those changes in technology since the late 90s.
Perfect. So what's in those new regs?
Sure, and these regs are right now they're in proposed form, so they're not binding on taxpayers or the IRS, and they will be effective for tax years beginning on or after the date of finalization. And it's hard to say when exactly they'll be finalized. Could be as soon as perhaps next year at some point. And there are two different parts of the regs. First part of the regs, we'll call it the -18 regulations, and we'll try to minimize code and reg citations here, but -18 refers to 1.861-18, and there are these are the rules that currently govern the characterization of computer softwares. So Dash 18 will be expanded to apply the same rules and principles to other transfers of what they call digital content. So digital contents would mean it would include anything that's in digital form and protected under copyright law, or is no longer protected solely because of passage of time, and is not limited to computer programs, but it also would cover things like books, music, and movies. And actually, even back in the late 90s, when the IRS first issued the Dash 18 computer regs, taxpayers were asking the IRS whether they should apply the same principles to digital books and movies. And at that time, the IRS declined to make a decision, and they just made the regs strictly applicable to computer programs. And now they finally said, okay, let's expand these rules and apply the same principles to these other digital contents. And there's a part of the Dash 18 regs that many companies will care about, which is how do you determine the place of sale? If you were to transfer digital content to someone, everything happens in the computer system over the internet. How do you determine where that sale occurs? And this issue is relevant for purposes of determining the source of that sale.
Sure.
And the proposed rule in that regard is a big departure from how many companies have been thinking about these rules. So we'll go to that in more detail. So that's Dash 18. And there will be a newly added Dash 19 regs that apply to cloud transactions. And cloud transactions are defined to mean any access, on-demand access to computer hardware. So these don't just deal with software and digital content, but online access to computer hardware or digital content or other technology resources.
Right, and the preamble talks about software as a service. It talks about platforms as a service, and then infrastructure as a service. And as a non-technology guy, at least the way I think about these things, and correct me where I go wrong, certainly software as a service is effectively software that you don't download onto your own computer, but you're effectively accessing the cloud to be able to use that particular software. When we think about the platform as a service, at least the way I think about this is kind of like the app development and where you go, whatever kind of phone system you're on, where you go to get your apps and where designers can go and put apps out in the market. And then the infrastructure as a service is those big, what I view as kind of the server farms and those places where a lot of companies have decided, well, they don't want to have to pay for all the infrastructure and the servers and keeping them cool and all of the other things that are needed to run a big server, for example. And so if you pay to somebody to be able to use that infrastructure, that's infrastructure as a service. And I mean, those are three relatively small examples. We could talk about games and other stuff. But that really is, I think, the attempt of what they're trying to provide some guidance to taxpayers.
Right, and even consumers like you and I, we probably use all sorts of cloud services that we don't even think about. I back up my personal PC to some online storage. Right. And that the data is stored somewhere securely in the cloud, if you will. And so really these regs, although they deal with a very specific kind of technology, I think one main takeaway is for me is that they don't just affect companies that make money from cloud transactions or digital contents. These regulations are important because they characterize a transaction from an income standpoint and from a payment standpoint. And so you don't have to be in the cloud business to want to care about these regs.
Right. So who should, so that's kind of why characterization is important. So who should care about these rules? Is it just these big companies, or who else should care about these rules?
I think it's really a mix of both U.S.-based multinationals and foreign-based multinationals, whether they are receiving income from cloud transactions and digital content, or they're making large payments or numerous payments for the use of these services and products. Because these regs characterize a transaction, meaning to treat a transaction as giving rise to sales income or rental income or royalty income or service income for various purposes of the Internal Revenue Code. Not for all purposes, but for various purposes, including withholding tax, foreign tax credit, U.S. trade or business, ECI, treaties, and transfer pricing. So any code section that's implicated by cross-border payments of digital content and cloud transactions will make these rules relevant. And so, to me, it's many times companies should care about them, especially when they're making cross-border payments, because they may have withholding obligations depending on how that payment is characterized.
So let's unpack that a
right.
little bit, because it's a great point. Just for the listeners that maybe aren't as familiar with some of these rules, generally the way our system, the U.S. system works, is we have this concept called FDAP, right? Fixed Determinable Annual Periodic Income. And generally, if a foreign person makes a payment that would be considered a U.S. source of a fixed determinable annual or periodic payment, what I can usually consider interest, rents, royalties, that you would look to see, well, what is the source of that payment? And if the source of that payment is U.S. source and it meets that character, then that's generally subject to withholding tax.
Right, and just take the cloud transaction -19 regs, for example. If, let's say, we're making a payment to a foreign provider of services and products for online access to software, then we have to decide, is that payment a service payment or is it a rental payment? Because the source of income rules are completely different.
Right.
If it's a rental payment, you look to the location where the property is leased. That probably is based on where the customer is accessing the technology. But if it's a service payment, the rule would be based on the source is determined based on where the services are performed. And in that case, it could very well be the case that the foreign service provider performs all of its services outside the United States, so you're making a foreign source payment not subject to withholding.
Right. Now, and then how does that, so the one way that U.S. collects tax when foreign persons make payments, U.S. source income, is through withholding tax. Mm-hmm. The other way is if the foreign person is engaged in U.S. trade or business, right, and then has income effectively connected with the U.S. trade or business. And so how do these rules potentially impact whether a taxpayer, particularly a foreign taxpayer, may have ECI? And we'll get into some more of the specifics, but just to kind of to lay the groundwork.
Right. So it could, the characterization of a payment could really impact ECI as well, because if it's a service payment and the services are performed outside the United States, then it's a item of foreign source income that should not be treated as ECI and therefore not subject to U.S. net basis taxation. But if it's a payment for, let's say, under the -18 regulations, if it's a payment characterized as a payment for a sale of product, mm-hmm. and in the fact pattern we're hypothesizing here, the foreign person has a U.S. trade or business, then you then have to determine, is that a U.S. source sales payment or a foreign source? And even if it's foreign source, could that income be resourced as U.S. due to some other factors? So characterization is also very important for ECI determination purposes.
Right, and it's important for taxpayers, particularly foreign persons, if they have ECI, if they have income effectively connected to a U.S. trade or business, they need to file tax returns, and then the failure to file tax returns could potentially result in gross-based taxation, because mm-hmm. you could lose your ability to be able to take deductions. And
That's
so,
right.
It becomes very important for those foreign persons to understand what the character of that income is, what the source is, and then they can determine, well, should there be subject to withholding tax if mm-hmm. it's not income effectively connected to a U.S. trade or business, or should they be filing U.S. tax returns because they do have a U.S. trade or business?
Right, and in that fact pattern, I think maybe one example of a particular change in these regulations we could cover now is the -18 regulations. I mentioned earlier there's a rule change regarding how to determine the place of sale. Determine the place of sale of a downloaded computer program or digital content. The IRS has, for the last 23 years, effectively given taxpayers the option of designating where the place of sale occurs in a downloaded transaction, in a downloaded computer program transaction. So depending on the taxpayer's profile, they can designate through their license agreements whether the place of sale occurs at the place of download, if that provides a better tax result, or the place of sale could occur at the place where the servers are located, for instance. So taxpayers have had some flexibility in designating the place of sale.
And this is easier and as a guy who kind of, as you know, grew up in the Midwest, like where companies bought and sold real, like, tangible products, right? And when you're doing real tangible products, like when you're working with your customer, like you're going to have a contract with your customer that says exactly where that title transfers, whether it's freight on board, maybe right when it gets onto the ship, who knows, but like contractually. And then that also has significant ramifications because depending who insures the physical property when it's being shipped across the sea. But in the technology space, it's just going just through the wires, right?
Right.
And so what you're saying is that companies just could contractually say where they wanted, and it didn't have some of the ramifications that I would normally think through when you're transferring physical product. It's just you would just have that contract, and the contract would say this is where we're going to actually where we're going to transfer title.
Right, and so you can imagine how the existing rules were really based on an analogy to the bricks and mortar business model, and now the IRS is saying, okay, in the new world, -18, going forward, the rule change will be that instead of allowing taxpayers to designate a place of sale, we'll say as a general rule, the place of sale occurs where the end user downloads and installs the software or digital content onto their computers. And so I think, the impact is that taxpayers, when this rule goes final, taxpayers will not have the option of designating the place of sale and therefore potentially the source of income. And this proposed rule change has really garnered a lot of negative press because some companies and practitioners don't like this change. They don't like the loss of flexibility to designate place of sale. But I think I understand the rationale.
Sure.
Because I think the idea is, well, until the time that the end user successfully downloads and installs the software product or digital content on their device, the sale hasn't completed. So I understand the rationale for this rule. And I think for companies, whether they are U.S. multinationals selling to foreign customers or foreign multinationals selling to U.S. customers, I think they need to take into account the potential impact of this change. But just because the place of sale is determined to be the place of download, that doesn't by itself mean that it's U.S. source or foreign source. You have to look to other factors. You have to consider whether the software or digital content is considered to be produced under Section 863B, because if it is, and your place of sale is different than the place of production, that could give you a more favorable or less favorable answer depending on the geography of these activities.
Sure. I think some of the other commentary that we've heard is that not everybody, not all of the digital companies, for example, are going directly to the customers. And so, while the theory, as I think you mentioned, kind of makes some sense in that respect, like practically speaking, how does a company, who maybe, has thousands, if not millions of downloads, how do they understand or how do they figure out exactly where those downloads occur? And then my understanding is there's also a lot of intermediaries where, there's a disconnect. There's not necessarily a direct result between the person or the company that has created the software, the product, if you will, and the end user. There's often intermediaries. And so it seems like, and this has been a common theme of cross-border tax talks,
right.
We talk about additional compliance requirements, and we talked about it on a prior podcast, Matt. I think one of the big complaints or what we've heard is just practically speaking, this might be very difficult for companies to try to get this information.
And I think that's fair. The REGS the drafters do try to provide some relief in the sense that the proposed rules say, well, if you can't determine exactly where the customers download or install their programs or computer digital content, then you can look to your business records to determine the place of the customer. Now, and I think that drafters are not usually people who have worked in companies, so they may not fully appreciate what kind of record compliance burden that companies have to go through. And I think it is time now for companies to think about how these rules might practically operate in their fact pattern and provide some suggestions to the Treasury and the IRS, because I think they would welcome that.
Yeah, I think one of the other comments is particularly as we think about foreign-based companies that are selling into the U.S. I think that, historically speaking, they would just say that they would be foreign title transfer, right? And so that foreign company or individual or whatever that is selling into the U.S. would not generally have effectively connected income or income effectively connected to a U.S. trade or business, because they'd say, well, all this was foreign source income. And it's a lot different now, right? If the end user is sitting in the U.S., then that could certainly change the analysis and result in a bunch of foreign companies with U.S. ECI and having to file, U.S. returns.
Right. So for companies like that, they have to really anticipate what happens to their structure when the regs finalize. And then the next step is, well, the regs say that place of sale is now in this hypothetical. Let's say it's U.S. because they're selling to U.S. customers who download the software onto devices in the U.S. Well, okay. But that's not the end of the story. Then I think the next step is to analyze whether they can treat their computer program as being produced outside of the U.S. and try to determine the source, taking into account both the location of sale and location of production, if any.
Right. And how do these rules apply? Because I think really these rules that we're referring to, these -18 rules, are really just the copyrighted articles. What about, we started the discussion talking about cloud computing, and that's really 19. The sourcing rules don't really give us any guidance on the cloud computing transactions. Can you kind of unpack that a little bit?
Sure. I mean, the -19 regs, they deal with cloud transactions, as we talked about earlier. That's defined pretty broadly to mean online on-demand network access to computer hardware, digital content, or other technologies. And those regs really deal with the situation where you're accessing technology online without download. And the regs we have now really only deal with the characterization issue. So the regs say...
Those cloud computing regs.
Cloud computing, the -19 cloud, exactly, cloud computing regs, they say we are going to apply this multi-factor test and determine a transaction to be either exclusively service transaction or exclusively a lease transaction generating rental income. And the factors that they're using are based on existing U.S. federal tax principles that distinguish service from rental transactions. And those rules have been around since the early 80s, or codified in the early 80s, and now adapted in the technology world. What the characterization rules say, they give you 11 examples. And in 3 of those examples, they say, well, actually these transactions aren't cloud transactions. They are digital content transactions. So go to -18 to look for their results. And the remaining 8 that are subject to -19 are all found to be service transactions. And so I don't think there's an inherent bias of service over rental. It's just that the business models that are described in these examples are treated as service transactions using these factors. But I could see perhaps in the future some new business models emerge that could lead to a different answer. But anyway, for now, they lead to service treatment, which is consistent with how most companies and tax practitioners have been analyzing these transactions.
And I want to come back to that because I think that really is important. I think that was probably kind of the least surprising of these regs.
Yes.
But really where I was going to come back to the 18, that we got these very specific rules on sourcing related to these copyrighted articles, but those rules, correct me if I'm wrong, do not apply to these cloud-based transactions. And so there's still the there's still the uncertainty with respect to how do we apply this type of sourcing principles to the cloud computing transactions where we don't have a copyrighted article.
Yes, and the government, based on public statements, we know that they are working on the source rules for cloud transactions. And I don't know when the source rules will come out, perhaps a year from now, perhaps more. Until further guidance is provided, all we have is the general source of service income principle, which is, well, it's based on the location where the services are performed. And you can imagine adapting that to a traditional model like where we work. Most of the work is done by individuals.
Right.
So it's perhaps easier to figure out the place of performance. But in a cloud setting where you have servers you have people doing the research, and some of the assets and people are your own employees and assets, and some are provided by related parties or third-party contractors. The questions are, what are the relevant activities, and from a people and equipment standpoint, what are the relevant activities that we need to take into account? And the more difficult question is, whose activities do we need to take into account? It's one thing to say, just look to the taxpayer's own people and assets. But it's another thing to say, well, are you supposed to take into account your activities of your agents, affiliates, or even third parties? I think this is probably one area where companies really want to think about speaking up and providing comments, because my personal view is, in order to make the rules administrable and practical, I think there's got to be a line to be drawn there. You can't require taxpayers to look to all activities and assets of everybody in the world that has some input.
Right.
I think existing source of income principles can support the idea that, as a general matter, you just look to the taxpayer's own assets and employees. You shouldn't have to take into account some other service provider that may be giving you data center support, but they're independent contractors. I don't think it would be appropriate to have to look at those other service providers and where they perform their service, because they're earning service income for themselves, sourced to where they perform their services, and the taxpayer, the relevant taxpayer, shouldn't have to look beyond what's practical and administrable.
Yeah, and one of the other, so I mean, these are really challenging issues, right? I mean, it's not uncommon to have a customer sitting somewhere in Europe, let's say Spain, and people along the value chain, if you will. And again, I'm using kind of terms from my widget background, but like in the value chain within the digital space, you could have a server sitting somewhere in Northern Europe. You could have people sitting in Ireland. You've got people sitting in the U.S. You've got people sitting in India or some other jurisdiction that all play a role as part of the process. And then trying to determine where that source from is obviously very challenging. I think one of the other things that I've seen some commentary on is, what about those companies that are monetizing data from individuals, and where they're collecting data and then monetizing that. And I honestly can't even wrap my head around how those type of sourcing rules would apply. But obviously that's becoming a much bigger market in today's digital age with social media. So presumably that's something that will need to be addressed at some future point as well.
And I think that's one where, again, I believe that companies should, the proposed regs contain a list of questions that the Treasury and IRS would like to have input on, and issues around source of service income I think is really ripe for constructive and helpful practical comments from taxpayers.
Yeah, and that's been a common theme amongst the various aspects of the TCJA. This is obviously outside the scope of the TCJA, but I think we've at least seen that the Treasury is certainly willing to take input from practitioners and taxpayers to inform those final regulations. All right, let's go back into a little bit of the cloud transaction piece, because I think that was probably maybe a little bit less surprising on the services income versus the rental income. But again, it defined it for more kind of black and white transactions, and I think a number of taxpayers are probably somewhere in the gray. But maybe go through again the kind of the lease, what the cloud transaction regs told us.
Sure, and so some of the general principles are, it's a sort of all or nothing characterization. So a single cloud transaction as defined is not bifurcated into a mix of rental and service components. It's either one or the other. And so in a way that's somewhat helpful for taxpayers, because you are putting all your characterizing that entire transaction into one bucket or another, but not partly of both. The preamble to the proposed regs recognize that certain transactions could have a mixture of lease of property characteristics and a mixture of service characteristics. They say, well, if let's say the under the multi-factor test, if some factors suggest that you have a lease transaction, but that factor is de minimis for example, then that's ignored, and you just look to the you look to the remaining the remaining characteristics of the transaction. I mean, the multi-factor test looks to factors like, does the customer physically possess the property? In this case, the property means, well, it's the software, the hardware being accessed. If not, then it's indicative of a service transaction. Mm-hmm. If the customer has physical possession, that's indicative of lease. Another factor is, does the customer control the property? Does the service provider have the right to determine what property is being used? And is the property being used to provide dedicated service to one customer or to multiple customers? If it's dedicated, then that suggests that supports lease characterization. But if it's being used to provide services to multiple customers, then that suggests a service characterization. One of the examples, say, they give you most of the factors that suggest service, mm-hmm. but then the server is dedicated for use by one customer. And in that case, the example still concludes that overall it's a service transaction. And so I think the issue here is, as technologies evolve, and there are many business models that the drafters probably aren't even aware of, there could be more transactions where it's not like 99% service and 1% rental, or the other way around. It could be 15% rental characteristics or 85% service. In that case, maybe it's not easy to say that the 15% is de minimis.
Right. Or even 50-50, let's say.
Or even 50-50, hypothetically, then what are you supposed to do? In that case, perhaps existing source of income principles could be used to say, well, you look to the predominant characteristic mm-hmm. of the transaction. It's a softer line than the de minimis test.
Right. And I think that maybe that's some comments that taxpayers and practitioners should consider to be able to provide some guidance there, because you're right. It tells us if it's not de minimis, what it is, but it doesn't give us the other alternative if those percentages don't work out as you described.
Right. There is one example where companies could look at where the word de minimis is still used, but the example itself also uses the term predominant benefit or something to that effect. And so I think even the drafters themselves do recognize that it's not 100% one characteristic or another, or even 99-1 or 90-10. I think the use of that phrase, predominant benefit, is helpful, and maybe companies can make further suggestions on how to make that line more manageable.
Yeah, because if not, we're just going to have to continue to rely on this old authority that obviously did not apply in the digital age to try to understand and characterize what that income is. So maybe, Matt, in closing here, what do you think? What should companies be doing? What advice do you have for companies that are subject to these proposed regulations?
I think for companies that are already in this cloud business, the way that transactions are characterized wouldn't be a big surprise to them. Mm-hmm. Where they could be affected are places regarding the change in the rule regarding place of sale for transfer copyrighted articles. Yeah. And so for those companies, they want to anticipate how that change in the rule could affect them, both from an inbound and outbound standpoint, and think about how to proactively manage their exposures, if any. For companies that are interested in the characterization and source of cloud transactions, I think giving some comments, practical and useful comments to the government would help craft the development, or would help the development of the source of income regs that are forthcoming. And for companies that are not in the cloud business but make a lot of cross-border payments for software transactions for cloud services, I think for those companies just to be aware that we do have these rules now that could provide some clarity on the characterization of their transaction, even though those companies are users of cloud rather than producers of cloud. They should be aware and think about their potential cross-border withholding and information reporting obligations.
It's a great point, Matt, that companies even outside of what you would consider the digital industry, everybody is doing things using the cloud, regardless of what fundamental industry you're in. And so, everybody can be impacted by those. And that's very consistent. We had Kalamana a couple weeks ago talking about BEPS 2.0. We were talking about digital taxation and these fundamental principles, and these rules, just like the fundamental principles of BEPS 2.0, can impact taxpayers of all types, not just those within digital.
Right, like the phrase from a few years ago is the entire economy is the digital economy.
That's exactly right. I think, Matt, that is a perfect place to end things. So thank you very much for joining.
Thank you, Doug.
Well, thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you to Matt Chen, an international tax partner in PwC's Washington National Tax Practice. I'm Doug McHoney, PwC's International Tax Services Leader. Stay tuned in 2 weeks for another exciting edition of Cross-Border Tax Talks.